Welcome to The Explainer. Today, we are unpacking a totally fascinating contradiction in the financial markets. We're looking at a crazy story where strict, by-the-book spreadsheet valuation models collided head-on with, well, real-world boardroom reality. The company in the spotlight? Thermon Group Holdings. They're an industrial tech company that somehow found itself at the absolute center of a massive valuation debate right before a multi-billion-dollar buyout. Let's figure out exactly what happened here.
So here's the central mystery we're trying to solve today. How on earth does a stock deemed 28% overvalued secure a massive $2.2 billion buyout? I mean, on one side, you have analysts looking at all their conventional metrics literally declaring the stock way overvalued. But then, on the other side, a real-world buyer steps in and happily pays a massive premium for the whole thing. How does that disconnect happen? Well, to understand it, we really need to look at the sheer momentum this company had built up.
148.15%. Let that sink in. That was Thermon's one-year total shareholder return leading up to the spring of 2026. This wasn't some slow, steady, boring climb. No, this was a powerful, unrelenting share price rally. Investors were absolutely piling in, and the stock was heavily outpacing the broader market. But, as the price just kept climbing and climbing, the traditional valuation analysts, well, they started to sweat a little bit.
By late May 2026, Thermon stock was trading at $65.71. But the most followed valuation narrative out there, specifically a model from Simply Wall Street using a 9.93% discount rate, pegged the stock's fair value at just $51. So, according to that model, the stock was nearly 29% overvalued. You had analysts warning of softer organic revenue, pointing out regulatory risks, and basically scratching their heads wondering what future profit could possibly justify a $65 price tag. But honestly, the answer was hiding right in plain sight.
Section 1. Accelerating financial momentum. To figure out why the market was completely ignoring those cautious fair value models, we just need to look at the concrete financial data Thermon was reporting behind the scenes.
They definitely weren't just riding on hype. Their core business was genuinely accelerating. When you look at their full fiscal year 2026 results, which they published in their 10K, the foundation is undeniably strong. Revenue climbed from roughly $498 million to over $536 million. That is a really solid 8% year-over-year growth. A lot of that was driven by geographic expansion, including this massive 58% jump in their Europe, Middle East, and Africa segment. But while annual growth is great, it was their quarterly momentum that really started turning heads.
In their Q2 results, Thermon delivered an absolute blowout quarter. Revenue didn't just grow, it jumped nearly 15%. And even more impressively, their gross profit margin expanded to 46.4%. They basically shook off macroeconomic inflation and tariffs like it was nothing. This incredible efficiency pushed their adjusted EBITDA up nearly 29% to $30.6 million for just that quarter alone. They were executing so well that management actually had to raise their full-year guidance. But as good as that was, solid execution in industrial heating was only part of the story. Section 2. The AI Data Center Catalyst. This brings us to the real accelerant, the massive factor that those traditional spreadsheet models completely failed to price in. Thermon was quietly positioning itself as a crucial picks and shovels infrastructure player for the massive artificial intelligence boom. They did this through a product called liquid load banks. Now, as the world rapidly shifts toward these gigantic liquid-cooled data centers to support AI, operators need a totally foolproof way to validate their cooling and power infrastructures before they actually go live. Thermon entered this super-specific market, and within just 8 months, they established themselves as a highly trusted provider of these vital testing solutions.
Listen to how Bruce Thames, the CEO of Thermon, described this in April 2026. He pointed out that the rapid expansion they were seeing in their bid pipeline really underscored the strength of early customer adoption in the data center market. They weren't just sitting around hoping for orders. They had already secured about 80 units right out of the gate. This was not some theoretical revenue stream projected for 5 years down the road. It was happening right then and there, in real time.
$400 million. That was the staggering multi-year opportunity pipeline Thermon identified for these liquid load bank solutions alone. And just to prove this wasn't some kind of pipe dream, their active quote log jumped by 70% to over $100 million in just the 2 months leading up to April 2026. They were projecting this specific market to grow at 20% annually all the way through 2032. This exponential growth curve? Yeah, that's exactly what that traditional $51 valuation model was entirely missing.
Section 3.
the CECO environmental buyout. And that leads us directly to the climax of this whole explainer.
While analysts were endlessly arguing over discount rates on their spreadsheets, another company recognized the immense, real-world value of Thermon's core stability, combined with that explosive new AI pipeline. Enter CECO Environmental. In late February 2026, CECO announced a definitive merger agreement to acquire Thermon for $2.2 billion. And this deal was incredibly lucrative for Thermon shareholders, giving them choices. They could take an all-cash option at $63.89 per share. They could take an all-stock option of 0.811 CECO shares if they wanted to ride the future upside. Or they could take a mixed bag of $10 in cash plus a partial share.
Think about the contrast here. The initial, conservative fair value model told investors the company was only worth $51, but the final, hard cash buyout price actually on the table? $63.89. That cash consideration represented a massive 28.37% premium over the stock's previous close. The market had been completely right to bid the stock up, and the traditional models had completely missed the mark.
To seal the deal, CECO ultimately paid 15.91 times EBITDA for Thermon. Now, in the traditional industrial heating sector, paying nearly 16 times earnings seems incredibly steep, like way too high. But remember that $400 million AI pipeline we talked about. CECO wasn't just buying historical cash flows. They were acquiring a high-growth, high-margin foothold in the absolute future of data center infrastructure.
Section 4, Final Delisting and Resolution. Once a massive transaction of this magnitude is agreed upon, things move fast.
The gears of the financial markets kicked in, and the timeline was incredibly swift. The $2.2 billion merger agreement was announced in late February. By May, Thermon released that final stellar 10K showing the 8% revenue growth. And then, on June 1, 2026, the whole thing was done. CECO paid out roughly $329 million in cash and issued over 22.5 million shares. Thermon's existing debt was entirely wiped out, and the stock was officially suspended and delisted from the New York Stock Exchange.
So we'll end with this question for you to really consider. Did traditional valuation models completely miss the AI infrastructure premium, or did CRSEO gladly pay for tomorrow's growth today? The Thermon story is a perfect reminder that backward-looking fair value estimates often really struggle to capture the explosive potential of new technological catalysts. A stock that looks mathematically overvalued today might just be pricing in a reality that the spreadsheets simply haven't caught up to yet. Thank you so much for joining me for this explainer, and definitely keep your eyes open for the next big market catalyst.